Imagine being the unluckiest investor in America. Every single time you have money to invest, you somehow buy the S&P 500 at its absolute all-time high. Every single time. No discounts, no crashes, no lucky timing. Just the highest price the market has ever reached. Sounds like a financial disaster, right? Now imagine someone else. She refuses to invest when the market is making new highs. Instead, she patiently waits for a 10% correction because she believes that's the smart thing to do. And then there's a third person, the one who keeps waiting, waiting for a crash, waiting for lower prices, waiting for the perfect moment. Years pass, that perfect moment never comes. Meanwhile, inflation quietly eats away at their money. So here's the million-dollar question. Who's actually going to end up wealthier? The investor with the worst timing in history? The patient investor waiting for bargains? Or the person who never invested at all? The answer surprises almost everyone. Today, we're using decades of real market data to answer one of the biggest questions every investor asks. Should I wait for a market dip or invest today? Welcome to Sam Invests, where we make investing simple, practical, and backed by data. Quick disclaimer. This video is for educational purposes only and isn't financial advice. Now let's dive in. The three investors. Meet our three investors. Investor number 1, Waiting Wendy. Wendy has a simple rule. I never buy when the market is at an all-time high. She waits for at least a 10% correction before investing. It sounds disciplined. It sounds logical. It even sounds responsible. Investor number 2, Peak Bridget. Bridget has unbelievably bad luck. Every year she invests, she accidentally buys at the highest point of the year. Literally the worst timing possible. Investor number 3, Fearful Frank. Frank wants to invest, but every headline scares him. Stocks are too expensive. A recession is coming. I'll wait until things calm down. 5 years later, he's still waiting. Most people assume Wendy wins, Bridget loses, and Frank, well, we already know what inflation does to cash sitting in a bank account. But real research tells a completely different story. The mistake most investors make, waiting for a dip feels safe. It feels smart. But make no mistake, it's still market timing. You're making a prediction. You're betting prices will be lower tomorrow than they are today. The problem? The market doesn't have to crash for you to lose. It only has to keep going up. And history shows that's exactly what markets usually do. What the data says. Researchers at Archbridge Family Office studied the S&P 500 going back to 1990. They compared 3 investing strategies. Strategy number 1, wait for a 10% correction before investing. Strategy number 2, invest immediately, even if the market just reached a brand new all-time high. Strategy number 3, invest on random days. Now here's the shocking part. Buying at all-time highs actually produced better average returns than waiting for a correction. Yes, the worst timing beat the patient strategy. How is that even possible? Why new highs keep leading to new highs? Because markets don't usually hit one new high and immediately crash. Healthy bull markets create dozens, sometimes hundreds of new all-time highs. Companies earn more money, the economy expands, businesses grow, investors become more confident, money keeps flowing into stocks. As a result, today's record high often becomes next month's bargain. While Wendy waits for a correction, the market keeps climbing. Sometimes that 10% dip doesn't happen for years, and when it finally does, prices are still much higher than where she could have invested originally. That's the hidden cost of waiting. Opportunity cost. While your money sits on the sidelines, it isn't compounding. It isn't collecting dividends, and it isn't growing. Why Bridget still wins. Now let's talk about Bridget. Sure, buying right before the dot-com crash or the 2008 financial crisis would feel terrible. Watching your portfolio fall 40% or even 50% isn't fun. But here's the key. Bridget doesn't invest only once. She keeps investing, year after year, crash after crash, recovery after recovery, bull market after bull market. Over decades, those early investments recover. Then they keep growing. A market peak from 20 years ago barely shows up on today's chart. Time quietly fixes bad timing. Think about it like this. Imagine planting an oak tree. Does it really matter whether you plant it on the hottest day of summer or the coolest day of spring? Not really. What matters is planting it and giving it enough time to grow. Investing works the same way. Time matters far more than perfect timing. Why our brains fight us? Here's the real enemy. It's not the market, it's psychology. Humans hate losses. Behavioral economists call this loss aversion. Losing $1,000 feels much worse than gaining $1,000 feels good. So whenever markets reach new highs, our brains whisper, wait, it's too expensive. It has to fall. The funny thing? Historically, markets making new highs often continue making even more new highs. That's why so many investors stay stuck on the sidelines. The cost of missing the best days. Now let's look at another famous study. Hartford Funds analyzed decades of S&P 500 returns. They discovered something incredible. An investor who stayed fully invested dramatically outperformed someone who missed only a handful of the market's best days. Miss just the 10 best trading days over roughly 20 years, and your total return gets cut by more than half. Miss the 20 best days, returns collapse even further. Here's the scary part. Those best days usually happen when everyone is terrified, right after major crashes, during maximum uncertainty, exactly when most people are waiting for things to settle down. By the time the news feels safe again, much of the recovery has already happened. So, should you ignore market valuations? Not exactly. Valuations matter. Diversification matters. Risk management matters. But trying to perfectly predict short-term market movements? History says that's a losing game. Instead, successful investors focus on consistency. Invest regularly. Keep buying. Keep holding. Keep giving your money time to compound. That's why so many long-term investors use dollar cost averaging, investing a fixed amount on a regular schedule, regardless of what the headlines say. It removes emotion. It removes guessing. And it helps you stay invested. One important reality check. Now before you invest every dollar into a single S&P 500 index fund, there's one important point. Almost all of the research we've discussed today is based on the US stock market. And while the US has been one of the world's strongest performers for decades, nothing says that leadership has to continue forever. Another issue is concentration risk. Today, a surprisingly large portion of the S&P 500's performance comes from just a handful of giant technology companies. That means you're not really betting on 500 equally important businesses. You're relying heavily on a small group of mega-cap stocks. If those companies struggle, the entire index can feel it. That's why many investors also consider globally diversified index funds alongside US investments. Diversification won't always give the highest return, but it can reduce the risk of relying on one country or one sector. Final takeaway. So, who wins? Not the investor with perfect timing, because they don't exist. Not the investor who endlessly waits for the perfect opportunity, because that opportunity often never arrives. The long-term winner is usually the investor who simply keeps showing up. Month after month, year after year. Bull markets, bear markets, booms, crashes. Consistency beats prediction. Time beats timing. And investing today often beats waiting for tomorrow. If you found this video valuable, hit the like button and subscribe to Sam Invests for more evidence-based investing videos that help you build wealth with confidence. Thanks for watching, and I'll see you in the next video.